As a developer, I think it is very important to understand the property clock or the market cycle, so to speak. And the reason for that is so that you can actually make informed decisions of, you can actually recognize and pick up the market indicators of what's actually going to happen in the market or where the market's heading. In theory, there are only two possible directions where the property prices can move. They can either go up or they can go down. However, when we don't know what actually is going to happen, whether it's boom or bust, and it's difficult to actually pinpoint a particular trend, and that's the time when the property market actually sort of remains flat. However, over a long-term period, the property prices will actually go up because of inflation. Because if you look at this, is the I took this out from ABS. If you look at the property prices in 1926 and what they are now, they are 14% above trend. That's the long-term trend. And if you look at this portion here and some of the portion over here, the property markets were neither up nor down, but they were kind of flat. And they are flat because the market is still trying to figure out what the trend is. Ideally, in theory, it's really the property clock is ideal in theory, but it's really difficult to actually pinpoint where it is right now. There's no crystal ball, but there are actually educated guesses, and there are indicators that should warn you or ring alarm bells, or actually tell you that okay, it's time to get in the market. So let's look at the market cycles. If you look at the development cycle, these are the four phases in any property cycle. Phase 1, 2, 3, 4, also known as maturity, decline, bottom, and growth. And what I've got written down underneath are basically indicators. And all I'm trying to do and give you in this video is a sense of the various indicators and market metrics, so to speak, that tell you where the market is heading. So if the market is actually in maturity, there'll be flat sales, there'll be weak price growth, steady or falling yields, and slowdown in building activity or a cautious market. When it's phase 2 and it's decline, there's a fall in sales. There's uncompetitive yields, and the projects are abandoned. You'll see a lot of projects are abandoned, and builders and developers don't really want to take those projects. It's because they actually went in the market over here, and by the time the project actually came back on the market was right here. And that's what everyone's got to be very careful of. However, a deal's a deal when it stacks up. So considering you have a broad knowledge of what the market is at, you can make an educated guess and informed decision and mitigate risk before you actually get into a property development deal. Phase 3, the market starts to pick up again, and the prices start to recover, and all these things happen over there. And in phase 4 is basically rising sales. I think right now Melbourne and Sydney are in phase 4, and it's really difficult to actually pinpoint whether the clock's right here or here or here, but it is somewhere here in this quarter right now. So let's look at another graph. It's actually very difficult to pinpoint where the market is at, or where the market is at the ideal balanced value line, because there's no such time apart from 2 times when it is there: once when it is recovering, and once when it's actually falling down. That's the only 2 times, and nobody can actually put their finger on it and say, okay, that's the time that when it's actually right where the prices need to be. So it's difficult to identify bottom. Investors, there's the right time to buy when the market is at market has started to pick up for investors, which was about 2 years ago. Developers, there's no right time to buy for developers, and the reason is because there are some concepts that I'll show you, that I'll share with you later on in the course, that talk about the perceived value of a site, in terms of what the developer can actually do with it. And it might not be the market value, but it is something what the developer can do with it, and we'll discuss that a little bit later. But basically, if a deal stacks up for a developer, it'll stack up. So and as long as they can mitigate the risk, as long as they can get the pre-sales required for that, you can get into a deal. So the property market moves between cycles of price growth and decline, and it takes time for a new trend to emerge. And during this time, prices generally stay flat. If you wanted to understand the different phases, let's look at phase one. Buyers start to run out of steam. That's what happens in phase one. What we were looking here, that is what was happening there. Buyers start to run out of steam. There are longer days on the market. If the property goes on the market, it takes a long time for it to sell. Consider selling NPAs, non-performing assets. So if you've got assets with a lot of debt, that is the time you would want to think about getting rid of them, or trying to reduce the debt, so that when the market actually hits the bottom, you can survive that. Phase two, spike in mortgage auctions. Auction clearance rates are usually less than 50% at the time, and that's the time you got to manage your debt and avoid distress sales, because the market is actually, sort of hitting the bottom at the time. Phase three, you've got home affordability improves. You invest in areas primed for capital growth, and how to do that we will discuss in the following videos, because where I talk about how you can start picking up the actual capital growth areas, and that's the time to actually borrow more or increase your debt. Phase four, strong demand, rapid price growth. That's what's happening right now. ACR, which is the auction clearance rate, is greater than 70. It has been for so long, especially in Melbourne and Sydney. I think the last weekend in Sydney was 89% auction clearance rate, and last weekend Melbourne was close to 80 to 86%. So that's the time you do that, and be aggressive during boom and conservative during a downturn. And astute investors adapt to changing market conditions, and that's what I'm trying to. That's why I'm trying to explain you this video, this concept. By varying their debt levels, by deciding on whether to develop and whether to hold. So these are certain conditions. These are certain decisions that a developer needs to make after they've developed. Are they going to hold what they've developed, or are they going to sell and cash out, pay tax, but still be able to reduce their debt and get out of a deal? I included these in the deal. It's like a little table that I put together where and all it does is it tells you different indicators of what's happening. If you look at supply, and when it's in recession, it's declining. When it's in recovery, it's minor. When the phase is expansion, it's actually beginning to increase, and when it's contraction, it's increasing greater than demand. So same with all these things. If you look at rents, when it's recession, the rents go down. So at any given time, if you could look at all these data, all this data, you should be able to tell where the market is at, and that will give you an idea and the confidence of when you're actually getting into it. Also, what you got to remember is that these things can also vary by suburb. So it's not necessarily the entire Melbourne's vacancy rate is one. But if you're doing a deal somewhere else in a suburb that's actually really prime, there's some development happening, there is new infrastructure being put in. So all those factors will actually impact irrespective of where the vacancy rate for the entire Melbourne city is at. So these are the things that you got to look at, and these are the things you should try and recognize and pick up. If you this is another thing that I just found this on the net. I didn't create this, I just found it out, but I think that this is really nice because it tells you what's happening when it's a slowdown. There is affordability crisis, there is stock oversupply, there is falling construction prices, there's abundance of tradespeople, valuations fall, more sellers than buyers, no confidence, rental increase, stock levels tightening, price rise, valuations rise. So all these things. So if you go through this module and have a look at it, you should be able to understand and get a grasp of the property market cycle, property clock, and understand excuse me, where the market is at.